All right, let's jump right in and crack open the financial analyst toolbox. Today we're going to tackle one of the biggest questions in all of investing. How in the world do you figure out what a company is actually worth? So, you're looking at a stock, and this is the million-dollar question, right? Is it a total steal, or is it a bubble just waiting to pop? Every single investor, everyone from Wall Street pros to someone just starting out, is trying to figure this out. And getting it right is, well, it's part science, part art.
And that science part? Well, that's where the toolbox comes in. We're not just throwing darts at a board here. Analysts have these tried and true methods for really digging in and figuring out a company's value versus its price tag. So let's go ahead, open up that toolbox, and see what we've got.
Okay, so here's the game plan. We're going to look at what really makes a company worth something. Then we'll pull out our first tool, the P/E ratio. Follow that with the P/B and P/S ratios. Then we'll get a little more advanced with something called EV/EBITDA. And by the end, you'll have this awesome new toolkit ready to go.
All right, first up, the big one. This is probably the most famous tool in the entire kit, the price-to-earnings ratio, or just PE. You hear this thing thrown around all the time, so let's really get into what it's telling us.
So what is it really? Simply put, the PE ratio tells you how much investors are willing to shell out for every single dollar of a company's profit. That's it. Are people paying a huge premium for those earnings, or are they getting a bargain? This number gives you that answer, straight up.
And the best part? The math is actually super simple. You just take the current stock price and divide it by the company's earnings per share, which is just the total profit spread out over all the shares. Seriously, that's all there is to it. Okay, let's put some real numbers on this. Say a stock is trading at 50 euros, and it's earning 5.64 euros per share. You run that simple division and bam, you get a PE of 8.9. So what does that mean? It means investors are paying 8.90 euros for every single euro of that company's profit. So why is a PE high or low? It's not just random. It really boils down to a few key things. First, how much profit does the company actually give back to its shareholders? Next, how much risk do investors feel there is? What kind of return do they need to see? And the big one, what's the expected growth? A company that everyone thinks is going to grow like crazy will almost always have a higher PE. The market is pricing in that future success. Okay, let's grab the next tool out of our kit. This one is the price-to-book ratio, or P/B, and it gives us a totally different way of looking at value.
So instead of looking at profits like we just did, the P/B ratio compares the stock price to the company's book value. And what's book value? Think of it as the company's net worth, on paper. If they sold off everything they own and paid back every single debt, what would be left over? That's the book value. And again, the calculation is super easy. You just take the stock's current price and divide it by the book value of one share.
Let's take our example company, Centralino. If its stock is at 50 euros and the book value per share is, say, 22.58 euros, well, that gives us a PB of 2.2. Now, anytime you see a number over 1, it's a signal. It tells you that investors think the company is worth more than just its physical assets. They're betting on its brand, its people, its future potential.
So what pushes that PB ratio up? A lot of the time, it comes down to one thing, profitability. Specifically, how good is the company at generating profit from the assets it already has? That's a metric called return on equity, or ROE. The better they are at that, the more the market is going to be willing to pay a premium over its book value.
All right, tool number 3, the price-to-sales ratio. Now this one is so important, especially when you're looking at companies that aren't making a profit yet. Think about a lot of tech startups, or even companies in industries that have big ups and downs.
Think about it. If a company has 0 earnings, you can't use a PE ratio, right? The math just doesn't work. But you can use the PS ratio. This one ignores profit and looks right at the top line, the revenue. It tells you how much investors are willing to pay for every single dollar that comes in the door from sales.
And you guessed it, the formula is just as clean and simple. Stock price divided by the revenue per share.
Let's run the numbers again. If the stock costs about $37 and the company brings in about $41 in sales for that same share, we get a PS ratio of 0.90. Now, when you see a ratio under 1 like this, it can sometimes be a little flag that a stock might be undervalued. Why? Because you're literally paying less than $1 for $1 of the company's sales.
Okay, time to level up. Let's pull out a more advanced tool from the toolbox. This is one that the pros really love because it helps them compare companies in a much more apples-to-apples way. It's called the EV to EBITDA ratio. Now I know, that sounds like a mouthful, but the idea behind it is actually pretty brilliant. First, you've got EV, or enterprise value. The easiest way to think about EV is it's the total price to buy the entire company. That means buying all the stock and also paying off all its debt. It's the true takeover price. And then you've got EBITDA, which is, look, it's basically a shorthand for a company's raw, core cash flow before a bunch of accounting and tax stuff gets in the way. So you're comparing the total buyout price to its raw cash-generating engine.
So in a real-world case, an enterprise value of around 7.7 billion Brazilian reais, divided by an EBITDA of 560 million, gives you a multiple of 13.7. And here's why this is so powerful. It strips out the noise. It lets you compare a company with a ton of debt to one with no debt, or one with a weird tax situation to another, all on a level playing field.
Okay, we've just unpacked 4 really powerful valuation tools. So let's lay them all out on the workbench and do a quick review of our brand new toolkit.
So here's the bottom line. The PE ratio, that's your classic go-to for stable, profitable companies. The PB ratio is fantastic for businesses with a lot of physical assets, like banks or industrial firms, because it tells you their on-paper worth. The PS ratio is your friend for high-growth or money-losing companies, focusing on their sales potential. And if you want to compare different companies like a pro, EV to EBITDA cuts through all the accounting noise. The key thing to remember is that no single one of these tells the whole story, but when you use them together, man, you get a much, much clearer picture of what's going on.
So now you've got the tools. You have this whole analyst's toolkit. But here's the thing. All these ratios, they measure what's already happened. They're looking in the rearview mirror. What they can't measure is vision. They can't measure leadership. They can't put a number on a world-changing idea that completely defies the spreadsheet. And that, well, that's where the numbers stop, and your own judgment has to take over.